Hi, I'm Don Simmons, and I'd like to talk about 2026. Predictions are difficult, especially when they're about the future. Okay, Niels Bohr didn't specifically use that to talk about the economy, but predicting the future is difficult at best, and it's impossible at worst. If accurate foresight were truly attainable, fortune tellers would win every lottery, psychics would be wealthier than Bill Gates, and portfolio managers would consistently beat the indexes. Of course, that's never the case. As investors, we're called to a different discipline. Rather than attempting to forecast the future with false precision, we rely on data, we study historical patterns, we filter out today's noise, and we thoughtfully discern a range of possible outcomes. With that framework in mind, it's worth noting that the current market rally may be the most hated rally in more than 40 years. The accompanying chart compares consumer sentiment with the frequency of S&P 500 all-time highs. What stands out is striking. Sentiment at the end of 2025 is at its lowest level since 1980. That pessimism in 1980 was understandable. The 1970s were defined by energy shocks, runaway inflation, which culminated in double-digit inflation during the Jimmy Carter years, a crisis that fundamentally reshaped U.S. monetary policy for decades. What's remarkable today is not the presence of uncertainty, but the depth of pessimism despite a market that continues to set new highs. Today's consumer pessimism stems from a different but equally powerful mix of forces. While headline inflation has cooled, prices never came back down, leaving households feeling a permanent loss as they manage monthly cash flow, not inflation statistics. Housing has become the new oil shock. Mortgage rates have doubled. Home prices remain near record highs, and younger buyers feel locked out, and existing home buyers feel trapped, undermining a core sense of stability and creating pessimism. At the same time, frustration grows as positive economic data, things like low unemployment, rising stock market, and GDP growth, clash with lived reality where credit card balances are rising, savings have been depleted, and inflation stress persists. Layered on top of this is a deep erosion of trust in institutions, in governments and corporations, and in the media. These are all increasing pessimism, viewed as ineffective and self-serving organizations, or they're just plain disconnected. In 1980, people feared inflation. Today, many people fear the system itself. But sentiment alone doesn't drive the market. As a result, the most respected economic and market prognosticators are divided about their outlook for the future. Industry forecasts about stock market performance for 2026 are mostly positive, ranging from plus 5% to plus 15%. In a study conducted by Bloomberg that was released on December 29, 2025, titled "Every Wall Street Analyst Now Predicts a Stock Rally in 2026," Bloomberg found that not a single one of the 21 prognosticators that they surveyed is predicting a decline. So let me summarize what I see. 3 optimistic themes and 3 pessimistic themes for 2026. Here's my positive themes. There are several constructed forces on the positive side of the ledger. Market consensus expects S&P earnings to grow roughly 13% in the coming year, while the Atlanta Fed estimates the U.S. economy is currently growing at about 4%. Consumer net worth stands at a record $177 trillion, providing a strong financial cushion. Even if today's enthusiasm proves to be an AI bubble, it may still be early in that bubble as the build-out is accelerating. Citigroup estimates AI-related capital expenditures could reach $2.8 trillion by 2029. Policy also appears supportive as the One Big Beautiful Bill is designed to incentivize investment in productive assets. Meanwhile, the current bull market is just 3 years old compared to a historical average of closer to 5 years. And there remains substantial dry powder with more than $7 trillion sitting in U.S. money market funds. Oil and gas prices are at their lowest levels in many years, providing a meaningful tailwind for both consumer and businesses, as energy costs ripple through nearly every part of the economy. Finally, improving deal activity suggests that cash is beginning to return to markets as animal spirits revive. So here's my 3 positive themes for 2026. First, continued growth driven by AI and productivity gains. Large investment managers broadly expect continued U.S. and global economic growth in 2026, supported by capital investment in artificial intelligence that's increasingly translating into real productivity and earnings gains. AI is no longer viewed as speculative enthusiasm alone, but as structural driver of efficiency, margins, and long-term growth across multiple industries. My second theme is that moderating inflation and a more supportive monetary backdrop may help. Many prognosticators expect inflation to continue trending lower in 2026, even if it remains modestly above central bank targets, allowing monetary policy to become less restrictive. This disinflationary trend, combined with the possibility of rate cuts or stable policy, creates a more constructive environment for both risk assets and economic activity. And my third positive theme is that energy is stable, and housing supply growth and consumer strength are tailwinds to the economy. Relatively low and stable energy prices are expected to support household purchasing power and help contain inflationary pressure. At the same time, increasing housing supply, particularly in multifamily construction, has begun to ease rental inflation, with rents and housing costs trending lower in many regions. This provides additional tailwind to consumer resilience and overall economic growth. So let me talk about some cautionary themes. There are several meaningful risks on the negative side of the ledger. U.S. stocks and bonds remain richly valued, while trade policy is still unsettled, with unresolved negotiations involving Canada, Mexico, and China, along with recent developments in Venezuela. And don't forget the Supreme Court reviewing the constitutionality of Trump-era tariffs. The outlook for monetary policy is also uncertain, as President Trump seeks to remove Fed Governor Cook and Chairman Powell is set to leave the Fed in May. And the path for future rate cuts remains unclear. At the same time, labor market conditions have softened, and while Wall Street is enthusiastic about the AI build-out, concerns about a potential bubble are growing. Finally, political risk looms as markets historically struggle in the second year of the presidential cycle, and the upcoming midterm elections add another layer of uncertainty. See the chart. So here's my 3 cautionary themes. First, elevated valuations and concentrated market leadership. While fundamentals remain solid, equity valuations, especially among the AI-related mega caps, are elevated, with several trading way above long-term historical averages on growth, price to earnings, and price to sales metrics. This leaves markets vulnerable to volatility or re-rating should earnings growth disappoint or sentiment shift, even without an economic downturn. My second concern is geopolitical and policy uncertainty. Geopolitical risks remain a persistent wild card, including the ongoing Russia-Ukraine conflict, instability in the Middle East, the Venezuela situation with implications for energy and trade routes, and rising tensions between US and China over technology in Taiwan. Add to that fiscal and political uncertainty across parts of Europe. While markets have proven resilient, any escalation that disrupts trade, energy supply, or capital flows could quickly alter risk assumptions. And my third cautionary concern is labor market tightness and wage dynamics themselves. Although job growth is expected to slow, labor markets remain historically tight, with unemployment projected to stay near multi-decade lows and wage growth still running above pre-pandemic norms. Persistent wage pressure could complicate the final leg of disinflation, potentially limiting how quickly central banks can ease policy if inflation accelerates. So here's my opinion. My outlook for 2026 points to a more moderate year for investors. At present, there's little evidence of an imminent recession or meaningful economic slowdown. However, I remain cautious given the very weak consumer sentiment discussed earlier. While sentiment alone doesn't typically drive markets, consumer spending is a critical engine of economic growth, and sustainable pullbacks in spending can weigh on the economy. I'm also mindful of the elevated valuations among the largest companies, which inevitably recalls the irrational exuberance of the late 1980s tech bubble. That said, there's an important distinction. Unlike many speculative, unprofitable companies of that era, today's Magnificent Seven and the leading AI firms are large, established businesses generating substantial revenue and growth. For that reason, a 2000-style collapse seems unlikely, though a meaningful correction that brings valuations closer to historic norms would neither surprise or concern me. So what should investors consider doing? Over the past several years, we've focused portfolios on participating in market growth through active management strategies, a strategy that served us very well. While buying low and selling high remains timeless, there are periods, particularly during technological transitions, when it can be prudent to hold high-quality investments even at elevated valuations as markets adjust to new drivers of profitability. In this environment, I believe a barbell strategy may be appropriate for investors to consider as it seeks to balance stability and liquidity with continued exposure to long-term growth. For retirees, this means maintaining sufficient cash, typically 18 to 24 months of spending, to weather a correction without being forced to sell equity at unfavorable prices. This is okay to hold a little more cash since current interest rates are not down at the basement level that they were a few years ago. At the same time, use of alternative strategies where appropriate helps manage volatility while preserving exposure to active managers positioned for growth. As you meet with your advisor, I encourage you to discuss your comfort level with potential market volatility and whether holding additional cash would provide greater financial confidence. For many retirees, increasing cash modestly from, say, 5 to 6% to 8 to 12% could help to meaningfully reduce stress without compromising long-term goals. So, thank you for the continued trust you place in me and our advisory team. We don't take that trust lightly, and we remain committed to helping you to pursue your financial goals thoughtfully, prudently, and without unnecessary risk. I wish you a very happy new year in 2026.